Hi everyone, in today's video we're going to talk about exchange traded notes, also known as ETNs. We're going to discuss what is an ETN, what are the advantages and some of the disadvantages of an ETN, and then we're going to compare an ETN with the better known ETF, exchange traded fund. So an ETN is often confused with an exchange traded fund, an ETF, but they're very different from one another. The first ETN was actually established by Barclays in 2006. One similarity is that both ETFs and ETNs are traded on an exchange, hence the term exchange traded, whether if it's a note or a fund. But an ETN is a unique financial product in that it gives exposure to areas of the market that you wouldn't necessarily have with an exchange traded fund or any other type of fund. Now let's go over some of the advantages and the disadvantages of an ETN. As I mentioned earlier, an ETN provides you, the investor, to be able to gain access to certain markets they wouldn't necessarily be able to get with an ETF. For example, an ETN can give you access to commodities like gold, gas, oil, currencies. Those types of things are very difficult to do, if not impossible, with an exchange traded fund, at least in a tax efficient manner. Also, an exchange traded note is very tax efficient because unlike an ETF that pays dividends or interest, an exchange traded note does not pay any dividends or interest. So the only taxable event that happens is when you actually sell your exchange traded note, your ETN. Now, obviously an ETN does have disadvantages. One of the greatest ones is credit risk. Because an exchange traded note is a debt instrument, there is credit risk by the actual company that's issuing the ETN. Also, it's important to note that ETNs are not FDIC insured, so there's no protection by the government if you were to lose your money. Lastly, an exchange traded note has no ownership in the underlying investments. You're essentially buying a note that is guaranteed by a financial institution to give you a certain rate of return on an underlying product. Unlike an ETF that holds those investments, an ETN actually has no investments. It doesn't own any investments. It's a debt issued by a financial institution. Now let's go over some of the key differences between an ETN and an ETF. The first one is the risk profile of both securities. An exchange traded fund has only market risk, meaning if something were to happen to that, if the market declines on that ETF, you lose value on it. It's got market risk. An exchange traded note, on the other hand, an ETN, has both market risk and it has credit risk. So if something were to happen to the issuer of that exchange traded note, then there's a risk of you losing money on that fund. For example, if you invested in a Vanguard ETF and Vanguard went bankrupt, that ETF would still exist because that ETF owns that underlying asset. But if Vanguard were to issue an exchange traded note based on some index and then Vanguard went bankrupt, you would not only lose your money, that exchange traded note, but the exchange traded note itself would no longer exist because it's tied to that fund, Vanguard. Another key difference is tax efficiency. Now, ETFs are known to be very tax efficient because they don't provide capital gains distributions. But an exchange traded note is even more tax efficient than an exchange traded fund because not only does it not do capital gains distributions, but it also does not issue any dividends or interest payments. All that is factored into the performance of the exchange traded note. So the exchange traded note is very tax efficient relative to an exchange traded fund. Now let's talk about the fee structure. An exchange traded fund typically has lower fees than an exchange traded note because the exchange traded note has a lot of fees that are associated with the issuer. In this case, it's usually an investment bank or some other financial institution. Another big difference between an exchange traded fund and an exchange traded note are the tax issues. So beyond just the tax efficiency, on an exchange traded fund throughout the year, it pays dividends and it pays interest. Even if those dividends and interests are reinvested, you have to pay tax on those dividends and interest. But as I mentioned earlier, the exchange traded note does not pay any interest or dividends while you own the fund. The only time you have capital gains or the only time you pay tax is when you have capital gains from selling it or a capital loss from selling it. Another key difference between an exchange traded note and an exchange traded fund are tracking error. an exchange traded fund has more tracking error than an exchange traded note. In fact, an exchange traded note has very little tracking error. What a tracking error is how closely the performance of the fund is to the underlying assets. So if you have an exchange traded ETF, if you have an exchange traded fund that tracks the S&P 500, there's always going to be some lag between the performance of the ETF versus the S&P 500. But if you have an exchange traded note that tracks the S&P 500, then there's going to be no lag between the performance of the exchange traded note versus the S&P 500. If you like this video, please remember to like, share, and subscribe to our channel. That way we can provide more videos like this. If there's a topic that you want me to cover in the future, please leave it in the comment section below.